If you've ever celebrated a higher credit score, like a financial promotion, you're not alone. Millions of Americans check their credit scores every month, hoping to see that number climb closer to the elusive 850. Credit card companies advertise free credit monitoring. Banks send congratulatory emails when your score goes up. Financial influencers post screenshots of perfect scores as if they've reached the pinnacle of financial success. Somewhere along the way, we've been conditioned to believe that an excellent credit score is the ultimate measure of financial health. But here's the uncomfortable truth. An 850 credit score does not mean you're wealthy. It doesn't mean you're financially independent. It doesn't even mean you're good at building wealth. It simply means you've demonstrated that you manage borrowed money responsibly. That's an important distinction because managing debt well and building wealth are two completely different skills. One measures how reliably you repay lenders. The other measures how effectively you grow your net worth. You can have an 820 credit score while living paycheck to paycheck with a mountain of debt. At the same time, someone with millions of dollars in investments might have a lower credit score simply because they rarely borrow money anymore. A credit score is not a report card on your financial life. It doesn't measure your savings rate, your investment portfolio, your retirement accounts, your emergency fund, or your cash flow. It doesn't know whether you're building assets that generate income or whether you're financing a lifestyle you can't truly afford. It only evaluates how you use debt. Today, we're separating one of the biggest myths in personal finance from reality. We'll explain what a credit score actually measures, why so many people confuse it with wealth, and what metrics truly matter if your goal is financial freedom instead of simply becoming a better borrower. Let's start with what a credit score actually is. At its core, a credit score is a risk assessment tool created for lenders. Banks don't care how wealthy you are, they care how likely you are to repay borrowed money according to the terms of a loan agreement. That's the sole purpose of your credit score. Your score is calculated using factors like payment history, credit utilization, length of credit history, types of credit accounts, and recent applications for new credit. Notice what's missing from that list. Your income isn't included. Your investment portfolio isn't included. Your retirement savings aren't included. The value of your assets isn't included. Even your net worth isn't part of the equation. Imagine two people. One has $2 million invested, owns their home outright, has no debt, and rarely uses credit cards. The other has $40,000 in savings, multiple credit cards, an auto loan, and a mortgage but never misses a payment. The second person may actually have the higher credit score because they are actively demonstrating responsible borrowing. Meanwhile, the millionaire could see their score decline simply because they aren't using enough credit. That doesn't mean credit scores are useless. Far from it. A strong credit score can save thousands of dollars through lower interest rates on mortgages, auto loans, and insurance premiums. But it's important to recognize what the score is and what it isn't. It measures your reliability as a borrower, not your ability to build lasting wealth. One of the biggest misconceptions in personal finance is assuming that people with excellent credit are automatically wealthy. In reality, many high-income earners with outstanding credit scores have very little actual wealth because nearly every dollar they earn is committed to servicing debt. Think about it. Someone can finance a luxury SUV, carry a large mortgage, have several premium credit cards, and make every payment on time. Their credit score may be exceptional. But if those monthly obligations consume most of their income, they're not financially free, they're financially committed. Now compare that to someone focused on building assets instead of liabilities. They consistently invest in retirement accounts, own income-producing investments, maintain a healthy emergency fund, and avoid unnecessary debt. They may have fewer active credit accounts, and therefore a lower score than someone borrowing aggressively. Yet their net worth continues growing year after year. This is why wealthy individuals often prioritize cash flow over credit scores. Cash flow pays bills. Cash flow funds investments. Cash flow creates flexibility. A credit score cannot replace financial resilience because lenders don't send you monthly income, they send you monthly bills. True wealth is measured by assets that produce value, not by access to larger loans. Your financial goal shouldn't be to qualify for more debt. It should be to need less of it over time. If an excellent credit score isn't the ultimate goal, what should you focus on instead? Start with your net worth. Net worth is simply everything you own minus everything you owe. Unlike a credit score, this number reflects whether you're actually becoming wealthier over time. Next, pay attention to your savings rate. Someone earning $70,000 who consistently saves 20% of their income will often build more wealth than someone earning $200,000 who saves almost nothing. Your savings rate determines how much capital you have available to invest and compound over decades. Another critical metric is your cash flow. Positive monthly cash flow gives you options. It allows you to invest, prepare for emergencies, and take advantage of opportunities without relying on borrowed money. Negative cash flow, even with an excellent credit score, creates ongoing financial stress. Also, measure your investment growth. Are your retirement accounts increasing? Are your investments generating income? Are your assets appreciating over time? These are the questions that determine long-term financial independence. Finally, consider your financial flexibility. Could you handle a job loss without panic? Could you pay for an unexpected repair? Could you take advantage of an investment opportunity if one appeared tomorrow? Those abilities reveal financial strength far better than a 3-digit credit score ever could. Here's the mindset shift that can transform your financial future. Stop treating your credit score as a trophy and start treating it as a tool. A good credit score absolutely has value. It can reduce borrowing costs when you truly need financing. It can help you qualify for better mortgage rates, lower insurance premiums, and more favorable lending terms. Those benefits are real, and maintaining healthy credit habits is worthwhile. But don't confuse access to debt with financial success. The goal isn't to impress lenders. The goal is to build enough wealth that borrowing becomes a choice instead of a necessity. As your investments grow, your emergency fund expands, and your income-producing assets increase, you'll rely less on credit to solve financial problems. That's when you're making real progress. Financial independence isn't measured by how much money banks are willing to lend. It's measured by how little you need to borrow in the first place. So by all means, pay your bills on time, keep your credit utilization low, and protect your credit history. But don't let a 3-digit number become your definition of success. Focus on increasing your net worth, strengthening your cash flow, reducing unnecessary debt, and building assets that work for you while you sleep. Because at the end of the day, banks celebrate people who borrow well. Wealth is built by people who own well. If this helped, like and subscribe to The Daily Yield, because we are making real financial progress one step at a time.